This SPY chart may look like any other until you zoom in, and when you do, you'll see the exact same pattern that triggered two sell-offs earlier this year is happening again. Positive gamma zone 586 to 592. 5. In this range, market makers, dealers, are long gamma, meaning their hedging tends to dampen volatility. Bull/bear pivots are noted at 590, 5, and 592, 5. Above 590, 5, dealers' hedging flow turns supportive. They buy dips, sell rallies, which can stabilize the market and even spark a short covering rally. If SPX pushes through the upper pivot 592, 5, it would enter a gamma squeeze zone where buying momentum can accelerate. TradingView.com. In other words, clearing 592, 5 could trigger a rapid upside extension as hedges are unwound. Negative gamma zone 577, 5 to 572, 5. In this lower range, dealers are short gamma, so their hedging can amplify volatility. A sustained break below 577.5 would push SPX into a region of limited support, where dealer flows could intensify selling. They sell into declines. Beneath 577.5, gamma exposure turns increasingly negative, and there is a notable void of support until roughly 570. In gamma parlance, below 577.5, the market enters a high volatility zone with heavy put dominance and few hedging buffers. TradingView.com. This implies that if SPX loses 577.5 and especially 572.5, we could see a swift, large-range decline toward the next major support, 570 or lower. As of Friday, May 23, 2025, the S&P 500 closed the week at 580.82, slipping 2.61% for the session and casting doubt on the index's short-term momentum. While the daily chart shows a modest defense of the 200-day moving average and a brief tag of the 20-day EMA, the weekly chart paints a more cautious picture. Historically, patterns similar to the current last two weekly candles, marked by an upper wick rejection followed by follow-through selling, have preceded sharp but measured drawdowns. Two recent analogs are evident on the chart: a 3.05% drawdown in late November 2024 and a 2.76% pullback in February 2025. In both cases, a long upper wick formed at or near highs, followed by a 2 to 3 week decline. Applying that same logic today, a minimum drawdown of 2.7% from this week's high of 596.6 would project downside risk to approximately 557.5. But here's the twist. This time, the stakes are higher. Why? Because bulls aren't just fighting a pattern. They're fighting two major moving averages at once. Let me break it down. Back in December and February, SPY formed this same setup: a double bar rejection off a local high, followed by a sharp 2.7 or 3% drop. Now, look here. Same red bar, same shape, same position, and the current drawdown? Already 2.7%. The math adds up, and history, it's not whispering, it's shouting. If this fractal holds, we're looking at a potential flush to 557.5, possibly lower, and there's not much gamma support below 577.5 either. Here's where it gets serious. Last time, the 20 EMA was still well above the 50-day moving average. Not this time. We're sitting right on top of both the 20 and the 50, and flirting with a full cross. A few closes below these levels could start a chain reaction. Momentum fades, confidence erodes, and algo-driven selling ignites. But before bears get too cocky, let's give the bulls their due. Price is still above both the 20 and 200 weekly moving averages. This week's red candle? Yes, it's bearish, but volume was light, likely due to Memorial Day weekend and seasonal slowdowns. Summer pullbacks are common, and historically, the S&P 500 often retests the 200 MA multiple times before launching toward new all-time highs. So, If the market can reclaim 595 and re-enter the positive gamma zone, bulls might force a fast snapback and trigger dealer hedging in their favor. This is a tension zone. Bulls need to reclaim 585 to 595. Bears want a clean break below 577.5. One side wins, the other gets squeezed. But there are important contextual differences this time. In both earlier cases, the S&P 500 was trading well above key moving averages. Currently, the index is balancing directly on top of the confluence of the 20-week EMA and the 50-week simple moving average, a level that should, in theory, provide stronger support. This zone around 578 to 580 represents a major technical inflection point. However, the structural advantage may be fragile. Should the index close below these moving averages in the coming sessions, the 20-week EMA could begin to curve downward. If that occurs while the 50-week SMA remains flat or begins to roll over, the conditions would be set for a bearish moving average crossover, a technical event that, while lagging in nature, often reinforces negative sentiment and momentum. Further compounding the concern is the relative weakness of the rate of change indicator, which is already sliding into negative territory. Momentum is fading, and volume on the weekly chart has picked up on red candles. These are all signs of a potential shift in trend. Today's market action was a classic example of indecision at critical levels, with major indices grinding around key resistance zones. SPY spent the session testing the upper end of its recent range near the 585 to 586 area, with intraday wicks suggesting both dip buying support and overhead supply pressure. The morning bounce was driven by continued strength in a few tech leaders, but by midday, sellers stepped in as price action became increasingly choppy. Bulls were hoping for a clean breakout, but the lack of volume on the push higher raised some red flags about sustainability. On the flip side, we also didn't see any aggressive follow-through from bears, suggesting the broader market may just be consolidating after last week's strong run. Trapped longs and cautious shorts may keep volatility elevated into the next session. If price can reclaim and hold above the 586, 50 to 587 zone with volume, we could see momentum shift favorably into the end of the week. However, a failure to defend today's lows may open the door for a quick fade back toward 582 or even 580, especially if macro data or yields turn against tech. If price can reclaim this zone and clear 595, it's likely we get dealer support from positive gamma flows. Bulls are defending the 585 to 586 area so hard, any pushback above 595 could cause forced rehedging and a snapback rally. If SPX loses 577.5, there's little gamma support below until 570, so the next leg down could be fast and brutal. We've mapped the key levels. Now it's about execution. Click the link in the description and join my options trading group. We don't just trade, we anticipate and we crush it daily. SPY is at a crossroads. One more bar below the MAs, and this market might not look the same next week. Let me know in the comments, are you leaning bullish or bearish going into next week? I'm watching the 577.5 zone like a hawk.